In March of 2026, something happened inside the vaults of Turkey's central bank that most people never noticed. In the space of 2 weeks, roughly 60 tons of gold disappeared from official reserves, sold and swapped by the one institution that is supposed to be the last line of defense for a nation's currency. $8 billion of bullion moved out the door in a matter of days, the fastest drawdown the country had seen in nearly 7 years. If that sounds like a footnote in a financial newspaper, you're missing the point, because what Turkey did in March wasn't really about Turkey. It was a preview watched closely by two countries that have spent the better part of a decade doing the exact opposite of what Turkey was just forced to do. Russia and China have not been selling gold. They have been hoarding it quietly and patiently for years. So when a nation like Turkey has to crack open its reserves just to keep its currency alive, the interesting question isn't why Turkey sold. It's what Russia and China do next, and there's a case that the answer is already moving through a market most investors have completely ignored: the silver market. To understand why this matters, you have to understand what actually happened in Turkey, because the headlines only tell you half the story. At the end of February 2026, a war between the United States, Israel, and Iran broke out, and within days energy markets convulsed. Oil and gas prices spiked, and for an economy like Turkey's, which imports most of its energy, that hit like a freight train. The Turkish lira, already fragile after years of double-digit inflation, started sliding toward a fresh record low. A central bank facing a currency in freefall generally has three tools. It can raise interest rates to make holding the currency more attractive. It can sell foreign exchange reserves to buy its own currency on the open market. Or if those options are exhausted or too costly, it can turn to gold. Turkey's central bank had already burned through an estimated $26 billion in foreign exchange reserves defending the lira. It wasn't enough, so it turned to the gold. Over the following weeks, official data showed Turkish gold reserves falling by nearly 60 tons, worth more than $8 billion at the time. About 22 tons were sold outright into the open market, adding new supply at a moment when Western gold ETF investors were also taking profits near record highs. The larger share went into something called a gold swap, where the central bank temporarily exchanges bullion for foreign currency liquidity, with an obligation to return the gold later. That's technically reversible, but it's still a signal the central bank needed liquidity badly enough to put its most trusted asset on the table as collateral. By the end of March, Turkey's reserves had fallen to their lowest level in more than 2 years. And here's the detail most coverage skipped past. This wasn't the first time Turkey had done this. Back in 2023, during an earlier bout of runaway inflation, the central bank sold around 159 tons of gold over a few months to cool domestic demand and shrink a ballooning current account deficit, then spent the following 2 years quietly rebuilding what it had sold. The same pattern played out again in 2026. By mid-April, just weeks after the emergency drawdown, Turkey's gold holdings had already climbed back to around 730 tons, up from a low near 693. The emergency sale wasn't abandonment. It was closer to a loan against the family vault, repaid as soon as the pressure eased. That detail matters because it tells you something the headlines mostly missed. Turkey didn't sell gold because it stopped believing in gold. It sold gold because gold is liquid enough, trusted enough, and universally accepted enough to bail out a currency in a genuine emergency. A currency can be printed into oblivion, and a bond can default, but a central bank's gold reserves, sitting quietly in a vault, can be turned into real purchasing power within days when everything else is failing. That's precisely the lesson Russia and China have already learned, and have been acting on for the better part of a decade. Rewind to 2014. That year, following the annexation of Crimea, Russia was hit with its first wave of significant Western sanctions. In the years that followed, the Russian central bank ran one of the most aggressive gold accumulation campaigns of any nation in modern history, roughly tripling its reserves while dramatically cutting its holdings of U.S. Treasury bonds. By the time the far more severe sanctions of 2022 arrived, freezing hundreds of billions of dollars in Russian reserves held in Western institutions, Russia's gold, stored domestically, was untouchable because it was never in a foreign vault to begin with. That wasn't luck. It was a deliberate multi-year hedge against exactly the kind of financial warfare Russia clearly anticipated it might one day face. China's story runs on a similar track but with a different emphasis. For years, the People's Bank of China has been one of the largest and most consistent official buyers of gold on Earth, adding to its reported reserves for extended stretches while trimming its holdings of U.S. government debt from the peaks it reached after the 2008 financial crisis. Public data from the U.S. Treasury and the People's Bank of China shows this rotation clearly: fewer treasuries, more gold. Many analysts believe the reported figures likely understate the true scale of accumulation, since some Chinese gold buying is understood to move through state-linked entities that aren't fully captured in the headline central bank numbers. Why would two of the world's largest economies spend a decade quietly reducing their exposure to the dollar and U.S. debt while stockpiling a metal that pays no interest and costs money to store? The answer goes back to a single afternoon in August of 1971. That was the day President Richard Nixon announced the United States would no longer let foreign governments convert their dollars into gold at a fixed rate, ending the Bretton Woods system that had anchored the post-war global financial order. Overnight, the dollar became a pure fiat currency, backed by nothing but faith in the United States government. For decades, that arrangement worked well because the U.S. economy was dominant, its institutions were trusted, and treasury bonds were considered the safest asset on the planet. But trust isn't permanent. It's a balance that gets drawn down, transaction by transaction, decade by decade. Since 1971, the purchasing power of the dollar has fallen sharply, a well-documented result of sustained inflation and the ability of a fiat currency issuer to expand the money supply whenever fiscal or economic pressure demands it. Nearly every recession, financial crisis, and war since has been met with the same basic toolkit: lower interest rates, more currency creation. The 2008 financial crisis alone saw the Federal Reserve's balance sheet expand by trillions of dollars through successive rounds of quantitative easing, and the pandemic response in 2020 dwarfed even that. The stated goal was always stabilization. The side effect was always the same: a growing supply of dollars chasing a finite stock of real assets. This is where gold, and increasingly silver, come back into the conversation as more than jewelry case metal. Gold has functioned as a hedge against currency debasement for a simple reason: no government can print more of it. Its supply grows by roughly 1 to 2% a year through mining, a rate dwarfed many times over by the pace at which fiat money supplies have expanded during major stimulus cycles. When real interest rates, meaning the interest rate minus inflation, fall or turn negative, the opportunity cost of holding a non-yielding asset like gold effectively disappears, and that has historically been one of the more reliable environments for gold prices to climb. Data from the Federal Reserve and Treasury markets shows this dynamic playing out repeatedly since 2008, and again with particular force in 2026, when gold pushed to an all-time high near $589 an ounce in January, before Turkey's emergency sales, combined with profit taking from Western ETF holders, dragged prices down more than 10% in the weeks that followed. Silver has always lived a strange double life. On one hand, it's a monetary metal with thousands of years of history as a store of value, traded and hoarded by empires long before paper money existed. On the other hand, unlike gold, most of silver's demand today, often estimated above half of total consumption, comes from industrial use. Solar panel manufacturing, electric vehicle wiring, electronics, and medical devices all depend on silver's conductivity, and demand from those sectors has been climbing sharply as the global energy transition accelerates. So silver's price isn't just a referendum on currency debasement and central bank behavior. It's also a bet on industrial demand growth. That dual identity creates a strange imbalance. When central banks like Russia's and China's rotate reserves toward monetary metals as a dollar hedge, their buying is concentrated almost entirely in gold. There's no real equivalent of an official central bank silver reserve program at anything close to the same scale, because silver is too small a market and too industrially consumed for central banks to stockpile the way they stockpile gold. But that absence is part of what makes silver's supply and demand balance so fragile in the first place. The silver market has run a supply deficit, meaning demand has outpaced newly mined supply in most recent years, according to data compiled by industry groups like the Silver Institute. And above-ground stockpiles that once cushioned the market have been steadily drawn down. Unlike gold, which is mostly hoarded and rarely destroyed, a meaningful share of the silver used in electronics and solar panels is used in quantities so small per unit that recovering it isn't economical, so it's effectively gone for good. So what would a coordinated pivot away from the dollar by major economies mean for a market this size? If investors watching central banks like Russia and China keep building gold reserves, while nations like Turkey get forced into emergency drawdowns, start treating precious metals more broadly as a hedge against currency and geopolitical risk, some of that capital has historically flowed into silver too, partly because silver trades at a fraction of gold's price per ounce and has, in past cycles, delivered outsized percentage gains once investor attention turns toward the metals complex. Analysts track this through the gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold. That ratio has swung wildly over long stretches of history, and some market historians point out that when it reaches extreme levels, silver has in prior cycles gone on to outperform gold for a stretch. That said, past patterns aren't a guarantee, and treating this as something that must happen again would be a hypothesis dressed up as a certainty. It's worth being careful here, because this is exactly the point in the story where it would be easy to slide into fear-based prediction, and that's not what good analysis does. Nobody can tell you with certainty what Russia and China's next move will be. What the public data supports is narrower. Both countries have spent roughly a decade showing a consistent, deliberate preference for gold over U.S. Treasury debt, and both have obvious incentives: sanctions exposure for Russia, long-term strategic competition with the U.S. for China, to keep reducing their dependence on dollar-denominated assets. Historically, when official demand for monetary metals rises over an extended period, it has coincided with periods of elevated investor interest in the broader precious metals complex, including silver, even though central banks themselves aren't typically the ones buying it directly. If this kind of story is the kind that makes you want to understand the machinery behind a headline instead of just scrolling past it, that's a good reason to hit like on this video and subscribe. Since this channel breaks down exactly these macroeconomic currents every week, I'd genuinely like to know what you think. Was Turkey's gold sale a one-off emergency, or a preview of the pressure other emerging economies could face if global instability continues? Drop your take in the comments. Now let's get into the psychological side of this, because it matters almost as much as the economics. People, and by extension markets, don't respond to information in a vacuum. Behavioral finance research has repeatedly shown that investors tend to underreact to slow-moving trends and overreact to sudden visible shocks. A decade of steady Russian and Chinese gold buying barely made headlines outside specialist financial media, because it was too gradual and too unglamorous to grab attention. But a sudden emergency gold sale, like Turkey's, framed in headlines about billions of dollars vanishing in weeks, grabs attention instantly, precisely because it's a shock rather than a trend. That's a well-documented pattern sometimes called recency bias, where people give disproportionate weight to recent, dramatic events over slower, more consequential shifts happening in the background. The uncomfortable part is that the slow-moving trend, a decade of central bank de-dollarization, may matter far more to long-term asset prices than any single emergency headline. Even though it's the headline that gets remembered. Consider a hypothetical, and I want to be clear, this is a fictional illustration, not a real person or event. Imagine an investor named Daniel, managing a modest retirement portfolio. He isn't a professional trader and doesn't watch central bank balance sheets for a living, but over the years, he keeps noticing the same headlines resurface. Gold hitting record highs, central banks buying at a record pace, a currency crisis somewhere forcing an emergency reserve drawdown. None of these headlines feel decisive on their own. Collectively, over years, they build a kind of background awareness that the foundations of the current monetary system are being tested more often than they used to be. Daniel doesn't panic, and he doesn't make some dramatic all-in bet. He gradually starts allocating a small, deliberate slice of his portfolio to precious metals, not as speculation but as a hedge. The same logic that's driven institutional and sovereign behavior for a decade. That's the kind of measured response serious financial thinking encourages, distinguishing panic-driven reaction from evidence-based positioning built on historical precedent, rather than chasing a headline after the price has already moved. Zoom out, and this all connects. The global financial system built after World War II was designed around one dominant reserve currency, the US dollar, backed initially by gold, and after 1971, backed by nothing but trust in American institutions and the depth of its capital markets. That system delivered decades of relative stability, but it also concentrated an extraordinary amount of monetary power in a single government's hands, including the ability to freeze the reserves of nations it considers adversaries, as the world saw clearly in 2022. Nations watching that precedent, particularly ones with strained relationships with Washington, drew an obvious conclusion. Dollar-denominated reserves carry a political risk that gold held domestically doesn't. That's the multi-year strategic logic behind Russian and Chinese accumulation. It isn't a bet that the dollar collapses tomorrow. It's a hedge against the possibility that political and economic tensions keep rising over the coming decade, and a bet that a reserve asset immune to foreign freezing is simply prudent risk management for a sovereign nation. Turkey's emergency gold sale in March of 2026 sits right in the middle of all this. It shows what happens to a country that hasn't built the same kind of reserve buffer when it gets caught in a geopolitical shock, in this case, a regional war and its energy fallout, without the deep, diversified reserves that a country like China, or to a different extent Russia, has spent a decade building. And it shows in real time the mechanism that makes gold, and by extension silver, valuable in a crisis, the ability to turn a stored asset into immediate liquidity when every other option is gone. So what should you actually take from all of this? Silver's price seems to be shaped by at least three forces moving at once, and it's worth holding all three in your head rather than collapsing them into one simple story. First, industrial demand tied to the energy transition, solar, electric vehicles, electronics, which has been climbing structurally with no clear sign of reversing based on published industry forecasts. Second, a persistent supply deficit where mined output has failed to keep pace with total demand in most recent years, gradually eroding above ground inventories. Third, investor sentiment toward precious metals broadly, which tends to strengthen during periods of currency instability, negative real interest rates, and heightened geopolitical risk, roughly the conditions that produced both the record gold prices of early 2026 and Turkey's emergency reserve sale weeks later. None of that guarantees a specific price outcome. Many economists would caution that commodity markets are notoriously hard to forecast with precision, and silver, in particular, has a long history of extreme volatility in both directions. But understanding the forces at play is different from predicting a number, and that difference matters if you want to think clearly about where markets might head instead of just reacting to whatever headline crosses your feed next. So here's the insight that ties this together. Turkey didn't sell its gold because gold failed. It sold gold because gold worked exactly as intended, a liquid, trusted, a political asset that could be turned into emergency cash when a currency crisis hit and every other option was gone. Russia and China have spent a decade building exactly that kind of buffer, not because they know precisely what crisis is coming, but because history keeps teaching sovereign nations, across centuries of currency debasements, defaults, and financial wars, that trust in any single reserve currency is never permanent. This was never really a story about Turkey, or even about gold. It's about a slow, deliberate shift in how the largest economies on Earth think about risk and trust and insurance policy against a financial system that has, throughout history, eventually tested the limits of currencies built on faith alone. Silver, sitting at the overlap of industrial necessity and monetary history, may be one of the quieter places that shift shows up in a market small enough for a change in sentiment to move it hard, and large enough that most people aren't watching until it already has. If this changed how you think about a headline you probably scrolled past a few months ago, that's the kind of thing we dig into every week here. So subscribe, stay curious, and I'll see you in the next one.